Um, as of April 2026, Advanced Micro Devices, or AMD, is experiencing a surge that is, frankly, so violent and persistent. It's basically breaking technical charts.
Yeah, it really
I
is.
mean, we are looking at a stock trading right near its all-time high of $287.61. It is up over 41% in just a single month, which is wild.
It's a massive move.
Right. So looking at the data, you really have to ask yourself this multi-million-dollar question. Is this a screaming, unmissable strong buy that's being fueled by this unstoppable AI enterprise revolution? Or is this a massive, cleverly disguised value trap just waiting to crush retail traders who are showing up late to the party?
Well, it really is the ultimate market paradox right now, I think. I mean, if you just scan the headlines, it's pure euphoria, right? You see massive deals, price target upgrades, all of that.
Exactly.
But if you look at the undercurrents, specifically what insiders are doing and what the options market is quietly pricing in, there are some really serious riptides forming beneath the surface.
Which is exactly why we are pulling out the magnifying glass today. In this deep dive, we're going to completely unpack AMD's financials, break down what the technical indicators actually mean in plain English, and look at some very revealing insider transactions to find the truth behind the ticker.
Yeah, there's a lot to dig into.
For sure. And just as a quick note for everyone listening, we are unpacking market data and fundamental trends here. This is an educational analysis, so it is absolutely not financial advice. Also, if you find this breakdown valuable, please like the video, subscribe to our YouTube channel, and definitely leave your comments and feedback below. It really fuels these future deep dives.
Right. And to really grasp whether this 52-week high is justified, we have to kind of ignore the flashy AI headlines for a minute and look at the actual cash engine supporting the valuation.
Makes sense.
You know, you can't evaluate a stock price in a vacuum. You have to look at the fiscal year 2025 performance data first.
Okay, let's unpack this, because on paper, those numbers look like a financial fortress. I mean, total revenue hit $34.64 billion. Right, that's a 34% increase year over year. Net income landed at $4.33 billion. Their gross margin is sitting at a very healthy 50%.
That's solid.
But the metric that really jumps out to me is their debt-to-equity ratio, which is sitting at just 5.11%.
Yeah, and that 5.11% is crucial for you to understand. Debt to equity essentially measures how much a company is relying on borrowed money to fund its operations versus, using its own cash.
And right now, borrowing is not cheap.
Exactly. In an environment where interest rates are a constant concern, carrying massive debt is incredibly expensive. But AMD has $7.71 billion in cash from operations.
Yeah, they're flush with cash.
They are. They aren't going to the bank to borrow money to build new chips that are funding their own growth. It gives them this massive strategic advantage over competitors who are burdened by heavy interest payments.
So they have the cash, they have the margins. But wait, I have to push back on this idea of a flawless financial engine here.
Okay, let's hear it.
If the fortress is so strong, why is there a glaring issue with their gaming division? The data shows a massive 35% sequential revenue decline in gaming.
Yeah, that is a huge drop.
AMD built its entire cultural identity on gaming GPUs and console chips. Are they just abandoning their original core audience? Why is that specific sector falling off a cliff right now?
It's a fair question, and the gaming decline is definitely stark. It's really driven by two main factors. First, we are deep into the life cycle of the current generation of consoles, like the PS5 and Xbox Series X.
Right, which both use AMD chips.
Exactly. The hardware cycle is mature, meaning demand naturally tapers off. Second, there's just a general macroeconomic fatigue. Consumers aren't upgrading their personal gaming PCs as frequently as they were a few years ago.
That makes sense. Everything is getting more expensive.
Right. But here is why Wall Street is largely ignoring that 35% drop. AMD is undergoing a massive fundamental identity pivot. They are transitioning from a consumer hardware company to an enterprise infrastructure backbone.
Ah, okay. And that pivot is definitely showing up in their forward guidance. Because despite the gaming slump, their Q1 2026 guidance points to roughly $9.8 billion in overall revenue.
Which is huge.
It is. That's an estimated 32.8% year-over-year jump. And earnings per share are estimated around $1.27. So if gaming is dragging them down, but revenue is still rocketing upward, something else has to be driving this.
And that something else is completely rewriting their valuation model. Gaming is notoriously cyclical. It booms and busts with holiday seasons and new console releases.
Right, it's unpredictable.
Exactly. Enterprise AI infrastructure, however, is currently being treated as an existential necessity by the biggest companies on the planet. AMD is essentially replacing this low-margin, cyclical consumer revenue with high-margin, sticky enterprise contracts.
Which brings us to the elephant in the room. The Meta mega deal. AMD just landed this bombshell multi-year partnership with Meta to provide AI infrastructure. But break that down for us. What does it actually mean when a social media giant buys AI infrastructure from AMD? Like, why not just buy from Nvidia, who historically dominated this whole space?
Well, what's fascinating here is that it all comes down to scale and leverage. Meta is training these massive language models, right? Like their Llama series.
Right.
And those require millions of hours of raw computing power. Now, if Meta only buys from Nvidia, Nvidia has ultimate pricing power. They can basically charge whatever they want.
Because there's no competition.
Exactly. Tech giants desperately want a viable second source to keep costs in check. AMD's management saw this opening, and they didn't just try to participate. They aggressively targeted the server CPU market. They are openly aiming for a 50% market share in servers.
Wait, taking 50% of the server market means they're actively dismantling Intel's historical monopoly in data centers.
Yes, taking aggressive bites out of Intel.
I mean, Intel stumbled hard with manufacturing delays over the last few years, and AMD just capitalized on it with their chiplet architecture, which, for the listener, basically allows them to build complex chips more efficiently and cheaply.
And it's undeniably working. Data center growth for AMD is projected at a staggering 68% year over year for fiscal year 2026.
58% growth.
Yeah, and that 68% growth is the primary thesis for the bulls. Management is looking at a medium to long-term target of $20 plus in earnings per share over the next 3 to 5 years.
So imagine being an institutional buyer managing a pension fund. You look at that 68% growth. You look at that Meta deal as the ultimate validation that AMD isn't just playing second fiddle to Nvidia anymore.
Exactly. You see a clear path to that $20 EPS, and suddenly the current price surge makes logical sense.
Right. But, fundamentally strong news doesn't always mean it's a good time to buy the stock. If that enterprise AI narrative is carrying the entire weight of AMD's valuation, we need to transition to the technical analysis to see if the market has already priced in this perfection.
Let's look at the chart.
So as of the close on April 21, the stock was sitting at $284.49. To put that in perspective, the 52-week low was $83.75.
It has more than tripled.
It's credible, and it's trading significantly above both its 50-day simple moving average of $265.58 and its 200-day simple moving average of $223.27.
And, those moving averages are essentially the psychological baselines of the market. The 200-day average tells you the long-term trend, while the 50-day average tells you what short-term institutional momentum looks like.
Right.
Because AMD is trading well above both, the trend direction is undeniably bullish. We are also seeing a MACD reading of 5.20, which is flashing a strong buy signal.
Wait, let's translate MACD for a second because it gets thrown around a lot. It stands for Moving Average Convergence Divergence. But really, it doesn't just measure the speed of a stock's price, it measures the acceleration.
Right.
Think of it like a car pressing on the gas pedal. A MACD at 5.20 means the car isn't just going fast, it's actively speeding up.
That's an excellent way to frame it. The momentum is accelerating, and the order flow shows very solid support levels established around $268 and $258.
Meaning if it drops, buyers are waiting there.
Exactly. Support levels are basically price points where buyers have historically stepped in saying, okay, this is too cheap, I'm buying. Now, the immediate hurdle or resistance is the all-time high at $287.61.
And if it breaks that?
If it breaks through that ceiling with heavy trading volume, technical targets point to a continuation up to the $311 to $326 range.
Wow. And Wall Street analysts are entirely bought into that continuation scenario. We looked at the consensus from 34 different analysts covering AMD right now. 79% of them say buy or strong buy.
Right.
21% say hold. And exactly 0% are issuing a sell rating.
Zero.
The average price target is $292.14, with the highest target sitting all the way up at $365. With 0% of analysts telling you to sell and the chart looking at the literal rocket ship, it just seems foolproof.
On the surface, it paints a picture of absolute certainty. But this is exactly where I have to raise a red flag.
Uh-oh. Okay.
Yeah, we have to shift the narrative to the hidden dangers here, because when everyone on Wall Street is screaming buy, you really have to look at what the people inside the company are actually doing with their own money.
Okay, what are the insiders doing?
Well, this is the bombshell. Over the last 3 months, SEC filings show that AMD insiders have sold $63.9 million worth of stock.
Wow.
Yeah, and the amount of insider buying during that same period, exactly $0. Even the CEO, Lisa Su, sold $16.9 million worth of shares just in March 2026.
Okay, wait. Here's where it gets really interesting. That is like a chef at a five-star restaurant sneaking out the back door to go eat fast food.
Exactly.
I mean, if the meta deal is so great and the chart is perfect, why are the executives cashing out? But let's contextualize that for a second. Executives in tech are heavily compensated in stock options. They have to sell eventually to pay taxes, or maybe they're just buying a house. Is $63.9 million really a massive red flag? Or is it just standard, scheduled corporate liquidations?
It is true that insiders sell for many mundane reasons. But the red flag isn't just the selling, it is the ratio.
The zero buying.
Exactly. When you see heavy coordinated selling across the C-suite with zero offsetting purchases from anyone else inside the building, it implies a collective internal sentiment.
Right.
It suggests that the people who know the company's internal data better than anyone else believe the stock price might have reached a near-term ceiling. And if we look deeper at the technicals, the indicators actually support that internal caution.
Okay, we just talked about the advanced CDs showing acceleration. What indicators are flashing a warning?
The oscillators.
Yeah.
Specifically the 14-day RSI, or Relative Strength Index.
Right.
For you listening, the RSI measures the speed and magnitude of recent price changes to evaluate if a stock is overbought or oversold. It operates on a scale of 0 to 100. Right now, AMD's RSI is at 69.44.
Which is borderline overbought.
Exactly. Generally, anything near or over 70 means the stock has gone too far, too fast, like an engine redlining, and it's due for a short-term pullback. Furthermore, the stochastic RSI, which essentially measures the momentum of the momentum, is over 80.
Oh, wow.
Yeah, which is heavily overextended.
So the engine is actively redlining.
Yeah.
And there was another metric in the data that points to serious market doubt. We are seeing a strangely high short sale ratio of 28.32% as of early April.
That is a remarkably high number. For context, short selling is when a trader borrows shares of a stock and immediately sells them, hoping to buy them back later at a lower price, return the borrowed shares, and pocket the difference.
It's betting the stock will fall.
Exactly. So a 28% short sale ratio means that over a quarter of the daily trading volume consists of people actively betting against AMD.
Which creates this fascinating, almost dangerous tension. On one side, you have retail traders piling into the stock. They see the meta headlines, they see the 41% monthly gain, and they are driven by sheer AI FOMO, the fear of missing out.
Greed, basically.
Right. But on the exact same day, you have institutional short sellers betting against the stock and company executives unloading tens of millions of dollars of their own shares.
Yeah.
Are we looking at a classic setup where retail traders end up buying the exact shares that insiders are unloading at the top? It feels like a retail trap.
It's the oldest transfer of wealth in the market. And all of this, the 68% data center growth versus this massive insider selling, brings up the most critical question of the whole deep dive. Is the stock simply priced too high? We have competing narratives, so the tiebreaker has to be the fundamental valuation.
Right. What are you actually paying for a piece of AMD's future right now? And the valuation debate is where things get incredibly sharp. Currently, AMD is trading at a staggering 109x PE ratio.
Which is massive.
It is. For anyone new to that metric, it means you are paying $109 for every $1 of earnings the company generates. By any traditional historical market standard, that screams significantly overvalued.
Yeah, to put a specific number on that overvaluation, we can look at the GF value. The GF value is an intrinsic fair value estimate calculated based on historical trading multiples, past business growth, and future estimates of business performance. The current GF value for AMD estimates fair value at $211.85.
Okay, meaning the current stock price of around $284 is trading at a massive 34% premium.
Exactly.
So I have to ask you, the listener, directly, are you willing to pay a 34% premium for a stock? Think of paying a 109x PE ratio like buying a house for 5 times its asking price because you are convinced the city is going to build a brand new subway station right next door in 10 years.
That is a perfect analogy. You aren't paying for the house as it exists today. You are paying a massive premium for a future event.
But playing the bull side for a second, maybe 109x PE isn't a trap if the Meta deal genuinely transforms their revenue pipeline. If they actually capture 50% of the server market, their earnings will explode. When earnings go up, that 109x ratio naturally drops down to a normal level. You're paying for tomorrow, not today.
That is the core philosophy of growth investing, sure. But the bear side counters with the inherent risk in your house and subway analogy. At 109x earnings, the stock has already priced in the subway station.
It's priced in 10 years of perfection.
Exactly. It assumes absolutely flawless execution. It assumes no supply chain shocks in Taiwan, no manufacturing defects, and absolutely no competitive response from Nvidia or Intel. At a 109x multiple, the company does not have the luxury of making a mistake. Any slight delay or earnings miss will cause a massive, violent correction.
And this brings the discussion to the immediate horizon, where that slight miss could actually happen. We don't have to wait 10 years to see if they execute.
No, we don't.
Because the next major catalyst is right around the corner on May 5th, 2026.
Right. The upcoming quarterly earnings report. This is where the rubber meets the road. Because expectations are priced so incredibly high, there is a very real downside risk of a sell the news event if growth doesn't absolutely shatter high expectations.
Break down sell the news for us.
A sell the news event happens when a company reports objectively good earnings, but because the market was expecting absolute perfection, traders sell their positions anyway to lock in profits, causing the stock to drop.
And you can actually see institutional traders preparing for this exact volatility if you look at the options market. There's a fascinating contradiction here.
Yeah.
While general public sentiment is registering as sheer greed regarding AI, options traders are quietly buying protective puts. The put-call ratio is currently sitting at 0.66. The smart money is buying insurance.
Right. Let's break down why that ratio matters. A call option is a bet that the stock will go up. A put option is a bet that the stock will go down, or it acts as an insurance policy.
So if you own the stock, you buy a put just in case.
Exactly. If you own an AMD stock but you're worried about earnings, you buy a put option. If the stock crashes, your put option gains value, offsetting your losses.
Now, 0.66 ratio still technically leans bullish, right? Because there are still more calls than puts overall.
Yes.
But the fact that it is creeping up indicates that large funds are terrified of what happens to a 109x valuation if the numbers disappoint. They want the upside if AMD crushes earnings, but they are hedging their bets.
So we are looking at two distinct outlooks for May 5th. In the best case, long-term recovery scenario, AMD delivers an absolute blowout quarter. They prove the financial impact of the Meta deal is already showing up on the balance sheet.
And the stock breaks out.
Right. It shatters that $287 all-time high resistance ceiling and continues its momentum toward the $311 to $326 technical targets on its way to that $20 plus EPS. The bears get completely squeezed out.
But the worst-case short-term scenario is pretty brutal. Earnings disappoint even by a fraction of a percent. Forward guidance is slightly softer than Wall Street modeled.
And boom.
Suddenly that astronomical 109x PE multiple is no longer justified. The multiple contracts violently, stock cascades downward, breaking right through those $268 and 200 PT at distort levels.
Validating the insider selling.
Exactly. In retrospect, that $63.9 million in insider selling looks incredibly prescient. And retail traders are left holding the bag.
It really is a high wire act. The fundamentals are strong, but the expectations might just be stronger.
So to briefly recap this incredible tension we've unpacked today. On one hand, you have a fundamentally robust tech giant with a bulletproof 5.11% debt-to-equity ratio, generating massive internal cash and executing a game-changing multi-year AI deal with Meta.
Right.
But on the other hand, you're wrestling with a sky-high 109x valuation, watching their legacy gaming division slump by 35% and seeing heavy insider selling by the executives who actually run the company.
Which leaves us with one final provocative thought to consider before May 5th.
Let's hear it.
If a company can secure a multi-year AI infrastructure deal with one of the biggest tech giants in the world, and the chart is hitting all-time highs, yet insiders are still aggressively selling their own shares by the millions, what do they know about the May 5th earnings that we don't?
That is the multi-million-dollar question. Are you looking at the foundational pillar of the AI revolution, or a perfectly executed value trap? The data is on the table, but the final read is up to you. Thank you for joining us on this deep dive. If you found this breakdown valuable, please take a second to like the video and subscribe to our YouTube channel so you don't miss our next analysis. And most importantly, drop your predictions for the May 5th earnings in the comments below. Do you think it breaks out or breaks down? Let us know, and we'll see you on the next deep dive.